From the morning reading, stocks have not yet tested the panic low from late August, violating most historical precedents. When we've gone 3 weeks from a low without coming within 1% of that low, it has typically led to even more gains over the next several months. Over 11 billion has flowed into the big four index ETFs over the past week, SPY, QQQ, DIA, and IWM. That's the third highest weekly inflow in the past year. While not as consistent as some other measures we watch, extreme flows in the major index funds have been more of a contrary indicator than not, suggesting a modest negative short-term bias going forward. In a similar vein, fewer than 25% of financials are trading above their 50-day averages, but more than 90% are trading above their 10-day averages. Of the 15 other days that this has occurred, the XLF fund has rallied over the next week only 4 times. The days were concentrated in 7 distinct time periods, and after 5 of those, financials backed off in the short term. Hello, this is Stephen Harris, a head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit every trading day. In this daily video, I provide my opinion and insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is 6:48 a.m. Central Time, and I'm recording this in preparation for the market day of September the 17th, 2015. Full disclaimers are at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. So let's dive on into our overnight action. Relatively modest, slightly down on all 4, but this is very, very modest. You could even call a couple of these scratch. But none of them are more than less than 0.25% down. Crude oil a little bit more of a story, down 1%. Euro up about 1/3%. Bonds down about 1/4. So kind of interesting. Bonds have moved more than the indices as a percent, though not a big divergence there. This is all pretty minor, really. And gold down about 0.2%. Overseas, a bit more active. China down over 2%. Hong Kong down 0.5%. And Japan up about 1.5%. Germany down up about 0.33%. In the United Kingdom, down just marginally. In terms of macroeconomic reports, this may be one of the biggest days of the year. There could be a big kind of misfire, but bottom line is we do have the Fed today, and this could be a very, very big mover. If you look at the market maker move that has been calculated for today, if you move as much as 37 points on the S&P futures to the upside or 37 points to the downside, I mean basically that range there could be plus or minus a big move, and that's a 75-point range between the upper limit and the lower limit of what's been factored into the options. So not a lot of expectation for small move today, so that would be certainly the surprise, that if we were to get a small move and not much were to happen. You do have other reports today. You have building permits, you have the weekly unemployment claims, you have housing starts and current account. You also have during market hours, in addition to the Fed, the Philly Fed manufacturing and nat gas storage. And then, of course, at 2 o'clock Eastern, we usually quote things in Central around here, but 2 o'clock Eastern is the FOMC statement. Remember that the press conference will happen about 30 minutes after the initial release. So you're going to, depending on how this is couched, you could have a headline number and that impact, and then you could have, as people digest the statement and look to see when perhaps the next change might happen, and then also more details as to what those expectations are and the explanation perhaps. But then the third hit could come from as this press conference starts and what comes out of that. So this could be something that's a little different than the typical macroeconomic report where you get the number and you're kind of done. This one could actually take much of the afternoon to be fully digested and to understand where the market really wants to go with that information. And it could be really quite whippy. Tomorrow, no significant macroeconomic report, so everything's really focused on today. In terms of our current volatility conditions, you see this skew well up over 135. That certainly is baking in an expectation of a multi-standard deviation move. Is of enhanced probabilities. So that certainly coincides with this expectation of the market maker move and the Fed announcement being a significant mover for this afternoon. Don't necessarily expect it to be totally flat and inside going into the Fed today. I heard some commentary about that. It often apparently can be quite choppy as people sometimes close things out in front of the Fed announcement, and other maneuverings can cause for some pretty choppy action. Keep that in mind. Short-term VIX almost to 24. So elevated conditions there, though IV percentiles are down really in the lower third. 35 for the S&P, 32 for the Russell, 32 for the NASDAQ, and 42 for the Dow. No standard deviation moves were put in yesterday. Again, that's probably going to change today. And notice also aged off are all those 2 and 3 standard deviation moves, though we have a little bit higher than average within the last 2 trading weeks. Number of at least 1 standard deviation moves still present. So volatility has subsided from what it was 3 weeks ago and 4 weeks ago now. But at the same time, this has not certainly gone away, and nor are we probably expecting it to be a quiet day today. In terms of our regular daily report, still a lot of negatives here. The uptrend under pressure from IBD. The accumulation distribution for the S&P did improve marginally to a C-. NASDAQ still remains an E. GMI index still remains a 0 out of 6 with a sell signal, and that author in cash. Primary market condition still remains strong bear, and the consensus of all this obviously is a strong bias to the downside, obviously until new information comes in and changes that. Decision point scoreboards remains with mostly red arrows on the intermediate and long term, though we've had some short term green arrows show up on each of the indices. There's been accompanying with that some talk about potential for a false breakout, and we have actually, if you look back on the charts, have had a number of false breakouts this year. And indeed, we go back to the SPX, we've had that big ranging action, and we've had a number of occasions where we would peek our head above or peek our head below and then just whip right back into the range. We've eventually, ended up expanded this range, but ultimately there have been a number of occasions, if you come back here, at the time that this occurred, this was a false breakout to the upside. We had kind of a false breakout to the bottom side on some of the ranging action, but most of the time these have been small probes, maybe run a few stops, and then reverse. And oftentimes it seemed like earlier this year that we would, break down, and then, 3-4 days later, it'd be like we'd be 80% of the way back to the top of the range, and we would probe the top and then fall. And this one is a good example: probe the top and then fall, but then you would get to a point where, all of a sudden, whoosh, 3-4 days later, you're 80% back, all the way back to the top of the range. And the people who were just about to get excited about being bearish are just totally stopped out. So this has been a very challenging environment to get any kind of follow through for either the bulls or the bears so far this year. So until proven that we can actually sustain a trend, your expectation is that things could come to a stop and reverse very, very quickly. It's not been a trending market in 2015. I'll also remind you of the IBD status. While we are now in our 8th, we had 8, I should say, confirmed uptrends. None of those have lasted any time at all, with the one exception of one lasting for 31 trading periods or days, and that one ended up with a minus 12 points to show for it. So it's been very difficult to be able to call the all clear for bulls in 2015. Now, if we, with the break of this pennant, we did break out of this pennant pattern or triangle pattern yesterday and close above it. Whether you look on the SPX, you look on the Russell, you look on the NASDAQ, this one's pretty obvious here, or you look on the Dow, all these had their either ascending triangles or pennant patterns broken with a confirmed close above those. But at the same time, we have clearly this action happening right in front of a big announcement, and this could get instantly reversed, and you could come to look at this as a false breakout by this time tomorrow morning. Or you could see this as that the institutions with their experts were front running the expected move and in front of what is expected to be a bullish move. If we do get the bullish move, we will likely run, and let's go back to the SPX. So theory A, bull move, will likely run up against this area here before we have any kind of real significant resistance. So that's a pretty significant move, some 40 points or so, and that makes sense also in the market maker move coming into today. We could easily make this move up into this prior support turned resistance area on the S&P. If we and at that point we'd have to see if the bulls actually have enough momentum to be able to continue that pattern, or if they would retrace before finally making another move up. So if this has indeed been an exhaustion pattern, look for this to run through this area here, perhaps stall here for the moment, and then retrace perhaps half of that move, and then make a move to go through and then back into the prior range, perhaps then even to all-time highs. That's the potentials for the bull camp. If this ends up being a false breakout to the bull side, and the Fed news brings in new information to the market, and this turns out to be rejected, I would look for that to come all the way down here to the prior lows. That would be a serious test of that area, and probably would visit somewhere within 1 or 2% of that area, plus or minus that line. And then if it were to get a confirmed breakout below that, then you go back to the October lows and below. So at that point, we would be looking at a serious potential of an all-out bear market and looking for a 20% net loss from the recent highs to that point. So pretty unusual that you're at a situation where on the one hand your theory is that we could go to all-time highs, and then theory B be that we could go to annual lows and perhaps even challenge an outright bear market. But that's just how evenly balanced we really are in many ways. So pretty interesting times today, and today could be that inflection point. Most of the time, it's my understanding that Fed announcements do not actually generate a trend change, but certainly there is the potential for that today. Now, current trend is actually bearish, so the expectation would be that we would continue down, and that this has just been a false breakout coming into today. But we'll see where that news takes us. In terms of the intermediate term market posture, very weakly bullish, though it continues to just keep moving up, and at some point we're going to have to drop that word very and that word weekly and just call it bullish. Obviously, if we get confirmation today, that could very much change this stance. But right now, the S&P is a 41, the Dow is a 47.5, NASDAQ is outright bullish at 61.5, and the Russell continues to improve as well, though very much behind the NASDAQ at a 41.3. Hedge warning status remains level 2. Elevated levels of risk in the market, and you see from the volatility base there's been a lot of hedging and put buying in front of this announcement, and you see that represented in some of these metrics. Market in decline, sharp increase warning are both present. VIX is above an 18. You do have the volatility ratio warning that fired actually 3 days ago. You do have a very high skew, and that means for a enhanced probabilities of a multi-standard deviation move coming into the market. New highs, new lows, actually 3 times as many new highs yesterday as lows, so that certainly, while not over 300, was a sign for the bulls yesterday. We've had really terrible breadth coming into recent weeks, and even those new highs that were set some weeks ago were done in very, very weak breadth. Very few companies participating in making those highs, and that is certainly was at that time a warning sign. Other things for the bulls, of course, the risk aversion indicators, all 5 of them are pretty nicely risk on. And in terms of special opinions today, really put everything on a big pause until that announcement comes out, and then reassess based on where the market digests that information and goes forward. In terms of sector-specific information, obviously quite a bit of healing here in the shorter term time frames, but again, we're at that inflection point. Perhaps most important, look at consumer discretionary. All 3 time frames up, but also pay attention to those that were the first to lead up, and if indeed we get the all clear for the bulls, we could see some of these sectors start to firm up and become true leaders. In terms of yesterday's action, energy of course was up way big at 2.7%. But was down last night, so we continue to see a lot of volatility coming out of the energy sector as they deal with their situation there. Look at who's down here at the bottom, though. Healthcare. It's can be a mixed sector. You can have high beta with like IBB and the biotech and other components like that, and you can also be very defensive with some of the industry groups in that sector, like hospitals and the like. So it's going to be kind of interesting to see where all this fleshes out. So that's probably enough for today. As always, if you find what you're hearing here is helpful to your trading, of interest to you, we greatly appreciate you retweeting us to your Twitter followers, to your StockTwit followers, to your Scootify audience, indicating that you like us with YouTube, subscribing to us on the YouTube channel. All these are things that you can do. Direct feedback can be sent to support@falconglobaltraders.com. More information about what we do every day can be found at this website. Disclaimers as always. Hit the pause button if you need more time to review the disclaimers. We are not your financial planner. And we'll see you back here tomorrow morning in what should be a very interesting 24-hour trading period. Good trading and make good decisions.